Okay, so let's try to build the plastic. Let's try to build a model for the plastic recycling facility first. So I just type in I wish to start a plastic recycling factory in USA. So it's gonna take roughly couple of minutes to generate the whole model. In the second window, I'm going to type in that I wish to start a glass recycling facility. I wish to start a glass recycling facility in USA. Now it's gonna take some time to generate the model. This one is almost done, and this is it's in step 3 for glass facility. So it's gonna take a couple of minutes. Glass recycling model, and here is the so let me just show you the statements, financial statements. So this is the glass recycling model. We have the income statement, the cash flow statement, and the balance sheet. It's all done by the AI in like 5 minutes, in under 5 minutes. This is the glass recycling model, and this is the plastics recycling model. So the plastics recycling model indicates that you need an investment of roughly 600K, and the glass recycling model indicates you need investment of 900K. And the glass recycling model shows a profit margin, a significantly higher profit margin compared to the plastic recycling one. Now I'm gonna dig into the numbers, and I'm gonna dissect why it's showing what it's showing. So first of all, we have to click on investment and figure out what's the investment, what are the investment assumptions. So based on this model, we have assumed that we are going to be investing roughly 400,000 in equity and 200,000 in debt, and the interest rate will be 8%. Now let's say instead of 8%, if it's 6%, obviously the profit goes up. If it's like 12%, the profit goes down. And if the debt payback period increases or decreases, this also has an impact on the financials. For example, instead of 5 years, if it's like 10 years, then it will put less strain on your cash flow during the first couple of years, which will obviously improve your profitability. There's another important thing in here, that is the break-even point for the plastics factory is 3 years, and the break-even is the for the glass factory is year one. This this also depends a lot on the pricing, the costs, and other factors which we are gonna dig into, and we're gonna play with the numbers and figure out what happens if we change one metric versus another. Now, in here, we have the option for additional investment. Let's say you start during 2026, and you wish to add more funds during 2027. Let's say you wish to add like 500,000 during 2027. So this will also have an impact on net profit and other factors, because as you invest more into the business, your potential to make more money increases. As you can build more capacity, sell to more customers. That's how the whole thing works. In addition to this, we have the capex items, which mostly involves the extruder line. This will also change depending on your revenue items. If you have more products, obviously you need to more invest more on capex items. Now let's look at the revenue items. But before that, I think it's better if you look at the growth and marketing. So in growth and marketing, we deal with how we are going to acquire the customers, and what percentage of those acquired customers are going to come through organic versus paid promotion. So this is the organic section. Let's say we start during 2026, and if we are able to start generate revenue from year one, then the launch year is gonna be one. And let's say it takes 1 year to set up all the machineries, all the factories and everything. And let's say we start from year two. Then all of a sudden the net profit and everything changes here. Now let's say the realistic estimate I think is year two. So let's put it year two, and let's play with the numbers and try to make this profitable. For now, it's unprofitable. So let's say that the initial number of organic customers is 40, organic growth rate is 5%, churn rate is 5. Let's say the year one promotion, we increase this to like 15%. Let's see what happens. As you can see, if we increase promotions, the number of customers acquired will change For example, if it was like 10% to 21,000, to get a better understanding of this, you need to look at revenue and direct cost section. So if I go to revenue and direct costs, as you can see, since we are not gonna be able to start operation in 2026, we are gonna be starting from 2027 onwards. So we get 498 pallets because the number of customers changes. To get an idea of the number of customers, we have to look into this. The number of customers. This number of customers is coming from the this particular section. So we are getting 40 customers to start with, and this organic number is growing by 25% based on our assumption, and the churn rate is 5%. Let's say if it is 1%, the net profit will change. And on in terms of paid promotions, we are gonna be spending 10% per year, and ongoing for the first year, and for the ongoing years, it's gonna be 8%. And these are our acquisition. These are our acquisition channels. Since this is a B2B business, so obviously the acquisition cost will be significantly higher. Now, if I change this, it will also have an impact on the profitability. Let's say instead of 1,500 bucks, if it's like 750, then obviously, as you can see, the profitability changes. Okay, now let's move on to revenue section, revenue and direct costs. So there are two types of cost or expenses. One is direct expenses and one is indirect expenses. Now, direct expenses are these type of expenses which vary with your revenue. So if your revenue increases, these expenses will also increase. So these expenses depend on the quantity of sales. And there are indirect expenses such as rent, salaries, which remain fixed whether you are irrelevant to whether your revenue increases or not. So these are the things. Now if I increase the price or decrease the price or increase the amount of sales per customer or adoption, these numbers will obviously change. For example, instead of 1,500, if I start charging 1,600, as you can see. So what was the situation earlier? 1,500. So if it's 1,500, then 60,000, and if it's 1,600, then we have 119,000. So as you can see, with small changes in pricing, a lot of stuff changes. These things cannot be calculated with simple spreadsheet, because when you increase your price, it affects your cash flow. It affects how much money you can pour into the marketing budget, which which will directly impact your um, your revenue growth. So let's keep it, let's lower it to like 1,400. So if I put it to 1,400, the break even year goes to like 5. If I make it 1,500, then it becomes 3. If I increase the price of raw material to like 400, then it goes to negative. So you can basically check out different scenarios with this particular thing. Now let's take a look at, let's like take a look at the glass recycling factory. Now in here it says that we are gonna break even by year one, but let's change some of the stuff in here. Let's increase the acquisition cost to like 1,800 bucks. Then see what happens. Still it's profitable. Maybe the profit margin is significantly higher. So let's look at the revenues situation. So we are selling it for 1,600 and we are buying it for 600. That's a significant profit margin. Now let's change the scenario. Let's say that this price increases significantly. Let's make it 800. So the moment I make it 800, as you can see, the whole scenario changes. Now let's make it 500. Let's lower it a bit and let's see what happens. Let's make it 400. As you can see, the profitability is gonna change. Now let's change some of the other stuff in here. So these are basically monthly expenses. These are monthly expenses. Now let's increase our monthly expenses a bit. Let's make utilities 10,000. So if I make it 10,000, a lot of the stuff is gonna change in here. Now you might notice that it says break even is gonna be year one, but it's gonna be unprofitable by year five. Now why is that? To understand this, we need to visit the financial statements. We need to look at two statements, income statement and cash flow statement. So first, let's look at the income statement. So According to the income statement, the business will remain profitable till year 4. Then what happens by year 5? This happens when a business is losing cash. So when the business loses cash and the business is reliant on cash for promotional budgets, then the business at some point of time it runs out of cash, which impacts the profitability. Now let's solve this issue. Let's look at the cash balance. As you can see, it's going to get negative over the years. This is a investment heavy business. So over time, even though the business is profitable, due to decrease in cash, this problem is occurring. So in order to get rid of this, let's look at the customer acquisition channel. So in the customer acquisition channel, what's going to happen is that we have to increase our share of organic customers, and we have to make some changes to this acquisition channels. So let's make it 800. So if we make it 800, all of a sudden what happens is your business is losing less cash, which over the years has a positive impact on your cash balance, which has a positive impact on your net profit as well. There's one important thing why the cash is suddenly decreasing in year 5. During year 5, you have to buy more machines because as so this is also taken care of by the AI. When it estimates that your revenue will increase, it tries to buy additional machineries to compensate for the increase in revenue. For example, if you are estimating that your revenue is going to increase over the years for your glass recycling factory, then obviously you need to invest more on the machineries. You need to buy more machineries to compensate for that revenue growth. So in order to compensate that, it calculates and figures out how many machines or how many additional machines are required. So it tries to compensate for it. And as you can see, during year 5, you are buying more than $1 million worth of additional machines, which puts a negative impact on your cash flow. So if your cash flow decreases, it obviously is going to impact the revenue. Now let's look at the income statement. So if I look at the income statement, as you can see, uh, during year 5, the cash flow the revenue did not increase significantly. It increased, but not significantly. And there was a significant drop in the cash flow due to expansion of the business as they had to buy more machineries. Now let's look at some of the key figures in here. For example, this is the break-even analysis graph. This is the capex graph. This is the plastic recycling factory. So based on this, the red line represents the cost and the black line represents the revenue. So during the first year, the cost is gonna be higher, and as you move forward, it's gonna change. For the glass factory, let's say that realistically the business should start during year 2. So let's say the launch year is like the second year. So as you can see, the launch year is the second year. Second year is considered as the launch year. Then a lot of things in here are gonna change. Now, if I change the churn rate as well, this is gonna change. Also, if I look at the capex and if I change this to like 0, and if I increase the share of equity in the business, this also has a impact on the profitability of the business. Since you don't have any debt, you don't have to pay interest, so interest expense goes down. This has so you don't have to think about all these things. You can just play with these numbers and figure out what happens if you do this, what happens if you do that. That's why this is called play. You can play around with the numbers. I'll share a link to the model for this and this, both the models, and you can just play around with the numbers yourself. You would have to create an account for that. So I'm going to share the editable links. So you can also share the links with anyone. For example, if I want to share this link, I'm just going to click on first. I'm going to click on there are two tabs: financial statements and input fields. So I'm going to click on financial statements. I'm going to click on public access. After that, I'm just going to copy this, can edit. I'm going to take the can edit version. I'm going to copy this and I'm going to basically paste it here, just like Google Sheets is gonna open up. So this window is visible for anyone. So you can just copy this. So I'm gonna share this particular link in my description, in the description of my YouTube video, so that you can just check out both the models and figure out which one you want to start. If you have any questions, I'd love to address them in the comment section.